Hi, good evening, everyone. Welcome to tonight's Ask Me Anything on Bond ETFs with Nikko Asset Management. My name is Gerald. I'm the founder of Beansprout, and I'm very pleased to be your host for today. With me, I have an expert on bond ETFs, Mr. Bertram Sarmago, who is investment director and portfolio manager at Nikko Asset Management Asia Limited. So at Beansprout, we share our insights on Singapore bonds, stocks, REITs, and ETFs. And Singapore T-bills have been a hot topic for many of our readers over the past few years. However, it isn't difficult to notice that the T-bill yields have been coming down in recent months. At the same time, I've also noticed more readers asking us about bond ETFs and how they can be used to build an income portfolio. So I thought it would be helpful to have an expert help us to understand more about bond ETFs. Given that tonight's session is a Ask Me Anything session, if you've got questions at any point in time, do put them in the chat box. Before we start tonight's session, just a quick disclaimer. Today's sharing is for information purposes only. Please speak to your financial advisor to get advice that's tailored to your investment objectives as well as risk appetite. So we'll start tonight's session with a question for Bertram. Maybe you can just walk us through quickly what are bond ETFs.
Okay. Hi. Good evening, Gerald. Thanks to Beansprout for having me here, and thanks to everyone attending this as well. Bond ETFs are, as you say, ETF itself means exchange traded products. So it's a listed fund. I can trade at the stock exchange, and it gives you exposure to a diversified basket of bonds, and you can trade it at one go. So it's like a stock, you can trade it at the stock exchange. In the same way that a stock ETF may offer you the ability to own many stocks, a bond ETF allows you to hold a diversified bond holdings in a simple way. There's been a lot of benefits in using bond ETFs amongst investors recently. As you mentioned earlier, T-bills have had a strong interest and continues to do so. Given that there's ongoing risk of tariff concerns, a lot of uncertainties in global markets. So T-bills and complementary bond ETFs continue to gain growing interest from investors. So these bond ETFs will give investors the ability to trade bonds in a diversified way, and it's been gaining popularity among investors. The total fund size as of end March for bond ETFs in the Singapore exchange is around 4 billion, whereas for our bond ETFs, which offer exposure to Singapore dollar bonds only, two of the bonds listed on the SGX with AUM for each above 500 million. We have the ABF Singapore Bond Index Fund and the Nikko AM Investment Grade Singapore Dollar Corporate Bond Fund. And these are two of the ETFs that we have investing in Singapore dollars.
Thanks for the very quick introduction about bond ETFs. I think you mentioned earlier that they are instruments that investors can consider, especially given the volatile market environment that we are in. And I think you also drew the comparison around how they can be a complement to T-bills. So maybe I would just start with a question that we've been getting a lot. How do bond ETFs actually compare to T-bills?
Yeah, so yeah, that's a good way to explain how bonds are different from T-bills in a way. So we have prepared a table here of various characteristics of T-bills, our ABF Singapore Bond Fund, and our Nikko AM Singapore Dollar Investment Grade Corporate Bond ETF. The first line here is yield. So T-bills are short-term instruments, so it can be 6 months or 1 year. So you get a specific yield, and that's good for the 6 months that you hold the bond. So currently, the yield of a 6 month T-bill is around 2.3. The last auction in May was at 2.3. And the yields is really depending on the tenor and when it was issued. Whereas the bond ETFs will be holding different bonds of different tenors, usually from 1 year to as long as 50 years. So currently, our ABF Singapore Bond Index Fund has an average yield of around close to 2.6, 2.57 as of end April, whereas the Singapore Dollar Investment Grade Corporate Bond ETF, because it invests in corporate bonds with higher yields, has a yield of around 3.18 or around 3.2%. In terms of minimum investment, it's really easy to invest in both T-bills and ETFs. So you can see here, minimum investment is only 1,000. Maximum investment, there's no limit. And as I mentioned earlier, the term for T-bills is only short duration, short term, which is 6 months to 1 year. And for the bond ETFs, it can have long duration or long maturities because we hold all the bonds that are in the index or the underlying index of the fund. So you can see the term or the duration of the ABF government bonds is 8.1, whereas for the corporate bonds ETF, it's around 5.7. So these are the average maturity of all the bonds that we hold. In terms of capital appreciation and capital guarantee, all of these don't have necessary capital guarantee, but because of who the underlying issuers are, you're more or less able to get your principal back. Similar for T-bills and ABF Singapore bonds, the underlying issuers of these bonds are Singapore governments or Singapore statutory boards. Whereas on the Singapore investment grade corporate bonds, we do hold corporate bond issues, but they're all of investment grade quality. So the capital appreciation potential is there for both the bond ETFs, while for the T-bills, the capital appreciation is really just getting back your principal because you pay it at a discount. Liquidity or flexibility, I think they're all flexible in the sense T-bills, you can go to your bank and sell it in the secondary market. So, but then you're exposed to interest rate movements at the same time, similar to the bond ETFs. You can trade it every day at the Singapore Stock Exchange, and it's daily liquidity. And we have primary brokers who will trade and make markets for the bond ETFs. And in terms of diversification, the bond ETFs definitely will have more diversification because of the fact that you hold a basket of bonds, usually around 100 or more bonds in these bond portfolios. Whereas for T-bills, it's just one bond. It's more or less a government issued security. But if you want to have more bonds in the Singapore government, then you have to have your own portfolio of bonds so that you can achieve some diversity.
Okay, so quite a lot to digest from this slide.
Yeah,
If I
yeah,
can maybe just go through some of the things that you mentioned earlier.
yeah.
For those of us who may not be familiar with the maturity and what you mentioned about the weighted average duration, how should we think about the weighted average duration numbers that you shared earlier? What does it really mean?
So duration really is correlated to when the maturity is of the bond. So the longer the maturity is of the bond, the longer the duration is. So duration is a common, what I call this, measure or of interest rate risk. So interest, as some most of the investors will know, bond prices move up and down reverse to how interest rates move. So if interest rates are going down, then bond prices will go up. So the duration number is an indication of how volatile it will be with regards to interest rate movement. So a very simple way to think about it, an 8 duration means it can go up 8% if interest rates go up by 1%.
Okay, so that's a very good rule of thumb to remember.
Mm,
And something that I always remind our readers is once again the inverse relationship that you shared earlier between bond yields as well as bond prices. Okay,
yeah.
so for many of us who are very familiar with investing in stocks, this might not be something that's intuitive, but the thing to note about investing in bonds is that when bond yields go up, the bond prices come down and vice versa. Okay, so that is just an important concept to take note of. Going back to Bertram's point earlier around how we should think about the duration of the bond ETFs. Okay, so I see more questions coming in now. I think one of the bond ETFs that you mentioned earlier is the ABS Singapore Bond Fund.
Yeah.
It is one of the bond ETFs that we commonly get a lot of questions on.
Mm,
So the question on the ABF bond fund is, can you maybe share a bit more about the fund? What are the underlying instruments in this ETF? And why should investors think about this bond ETF
mhm.
when we can actually apply for T-bills ourselves?
Correct. Okay. So the ABF Singapore Bond Index Fund is a investing in Singapore dollar government bonds and statutory board bonds mainly. So you can show in slide 4. So this fund was launched in 2005 along with other government bond ETFs to support the government bond market, really to develop the local currency bond market. So bond ETFs that we have, these are all index tracking ETFs. So this index tracks the iBox ABF Singapore index. So it composes, you can see here, the allocation by issuer. It invests in Singapore government bonds and also the statutory board bonds, HDB, LTA, some Temasek. And so it includes bonds mainly from government issuers, and it holds a basket of these bonds from as low as 1 year to as long as 50 years. So you can see here in the top 10 holdings of the ETF, it's our all government bonds maturing from 2026 to the longest bond that we hold is around up to 2072. So we really hold a portfolio of bonds and just across this government issuer. So essentially, if an investor wants to gain exposure to government bonds and is comfortable with the duration or interest rate risk of a longer duration bond ETF, then this is what they will consider. Most of the time, this is really a diversification allocation for other asset classes because it's government bonds.
Okay, so that is very helpful to know. And I think what we have also noted is that the bonds issued by the Singapore government are actually triple A rated.
Mhm.
So that would actually make them one of the most well rated bonds issued by governments globally.
Yeah,
Okay, one of the other bond ETFs that you mentioned is the Nikko AM SGD investment grade corporate bond ETF.
yeah.
Can you maybe also share a bit more about this particular ETF?
So this ETF was a newly launched ETF. From my view, I've been in this industry since 2004, 2005. So the ABF was launched in 2005, but the Nikko AM SGD investment grade corporate bond ETF we launched this in 2018, really to offer access to investors in the SGD corporate bond space. So, and this focuses on high quality investment grade corporate issuers. So, these are all your high quality companies as well as statutory boards. So, you can see here in the top 10, you have Temasek, NTUC, Singtel, UOB, and so we invest in all investment grade quality bonds only, and then you can see the allocation by sector. The top allocation is still government agencies, followed by banks, real estate, and financial sectors. And so it's really more or less a diversified portfolio of investment grade quality issuers. For a lot of investors, this will have a more attractive yield. You can see here at 3.2% compared to your T bills currently of around 2.3%.
Okay, and once again, for those of us who are not so familiar with the different terminology when it comes to bonds, can you help us understand what is investment grade?
Investment grade is a credit rating to measure the potential for or ability of the issuer to pay back the debt, the bond, because bond is essentially a borrowing or a debt. So the higher the quality, then the higher the probability that you will get your principal back. So the highest quality is, for example, the Singapore government. It's a triple A rated issuer, while the all the other, as you go down, a lower credit quality bond will be a double A, and then you have the single A, then you have the triple Bs. Essentially, for us, we only hold from the triple As, which are the statutory boards, and then the triple Bs for some of the corporate issuers that are rated triple Bs, and those are the minimum credit rating that we would invest in. And so, really, it is a measure of credit quality.
So, to put it another way, am I right to understand that because these are issuers who are deemed to have better credit quality, so from the credit rating agency's perspective, the likelihood of them defaulting would be potentially lower compared to some other issuers with a lower credit quality?
Yes, correct. So there is a low probability of default. But usually, if there's a downgrade of these issues that we hold, they will also be removed from the portfolio. So they will be exiting the index, and we will also be removing these bonds that are of considered non-investment grade.
Okay, so you earlier mentioned the dividend yield for the two ETFs. I think for many of us who have joined tonight, it is really from the angle of how that can potentially complement our income portfolios.
Yeah.
Maybe you can share a bit more about how the payouts are actually done. How should we think about the yields of both of these ETFs?
So the yield that we've shown earlier is not necessarily the dividend yield that you get. The yields that you can see from the fund fact sheets or the one that we showed earlier is really the average yield to maturity of the bonds that we hold. So in terms of dividends, the two ETFs that we have, we pay out dividends on a semi-annual basis. So these are subject to our discretion, and usually this is based on the coupon income that we received. And for example, using the ABF Singapore Bond Index Fund as an example, we paid out in January 2025 and also in July 2024. So it's a twice a year payment. So for example, the last NAV or the valuation of the fund is around 1.103. The payment was around 0.025 for those two payouts. So the average distribution for the ABF is around 2.27% for the last two payments. So that's just an indicative of how much the bond ETFs gives. And it's usually the yield is an indicator, but it's not the final dividend yield.
Okay, so that is from a dividend perspective.
Yeah.
So for an investor who might be thinking about this ETFs, how should we think about how we look at the value of the ETFs? I think the dividend aspect is one component. Earlier, you mentioned the net asset value. How do we think about the net asset value in thinking about the price of these two ETFs?
Yeah. So the advantages of bond ETF. So bond ETF, they will offer capital gains if interest rates fall. So you can see in slide 6 that we prepared, the price of the bonds may go up should interest rate decline. So for example, in one of the slides here, this is the valuation of the NAV. This is the price of the investment grade corporate bond ETF. That's the white line. So you can see the NAV is moving up in the last 1 year, and on the white line is a drop because of usually when you pay out dividends, then the price of the bond is of the ETF is reduced. But if we assume that it's being reinvestment, this is the orange line. Instead, in terms of steady growth for the NAV in the last 12 months, and this is really because of interest rates declining in the last 1 year. We saw it in around the June to September period. And we also saw it again during the height of the uncertainties in the last few months, wherein you can see the NAV rising again because of interest rates falling. So this is one of the benefits of buying a bond ETF, is that there's capital appreciation if interest rates fall. And yeah.
So before we go into discussing the potential advantages of the bond ETFs, maybe just to do a quick recap here. So in terms of thinking about my total return of the bond ETFs, I
Yeah.
should be thinking about both the yield as well as the NAV changes of the ETF. Is that correct?
Yeah, so yield meaning the dividends, right? So
Mm.
it's your dividends plus the price changes of the underlying ETF. So you can see the return in one of the slides that we prepared. So the total return is a combination of the price change of the NAV of the ETF plus the dividend. So this is a table of the various returns of the fund, NAV to NAV, plus adjustments of the dividend. So in the last 1 year, the corporate bond ETF returned 6.7, and compared to the ABF, even the ABF ABF Singapore Bond ETF performed higher than this because the government bonds has generally performs well during globally uncertain environments like we have currently. So yeah.
So that is a very good clarification because we often get questions around how we should think about the total return of bond funds and bond ETFs. I think some investors who might be familiar with, say, a money market fund may just think of it from a NAV perspective. Some investors who have always invested in, say, dividend stocks may look at it from a dividend yield perspective.
Yeah.
So I think it's always good to think about the different components from both
Mm.
the NAV as well as the dividend yield perspective.
Yeah, I
Uh,
think yeah, agree. Yeah.
so you mentioned some of the advantages of the bond
Sure.
ETS, which is the potential for upside if the interest rates were to come down. What are some of the other potential advantages we can think of for bond ETFs?
Sorry, for the other advantages will be the resilience even in economic downturns. So you can see in the next slide, it's about the high quality of Singapore bonds. So Singapore is a triple A rated sovereign. It's been triple A for decades, and so it's even has, if you can see the table here, a higher credit rating than the United States and more of the other countries. So this resilience will deliver when you have volatilities or an economic downturn. So the ABF Singapore index performs well during previous financial market uncertainty. So the credit quality plays well. For example, during the height of the global financial crisis, or even now where you have a lot of uncertainties, Singapore bonds, the AAA rating help it in terms of good investor support.
Okay, so we have covered some of the advantages. One aspect of investing that we always share with our readers is that all investments come with risk. So how should we think about the risk that come through from bond ETFs?
So yeah, the investing in bonds have their own risk, and we mentioned the positive side earlier about capital appreciation. So on the flip side, you can have capital losses when interest rates moved higher. So you can have investment losses because of interest rates moving up. So we saw that during the high inflation period in 2022, and so the bond ETFs are exposed to higher interest rate risk, and we don't provide that. There's no guarantee that you will be able to get back your investment, especially if you exit at the point where interest rates are rising. So the interest rate risk is there, and there's also the credit risk given the underlying quality of the bond. But for the ABF Singapore bond, you have AAA bonds, so the credit risk is sort of like minimized. But yeah, you are exposed also to interest rate and credit risk.
Okay, so once again, as a reminder to viewers, some of the risks that are mentioned for the bond ETFs, the first is really should interest rates actually go up, then there's a risk that the price of the bond ETF will come down. So that is the interest rate risk that we need to be aware of. And then the second risk that Bertram mentioned is really around the underlying credit quality of the bonds. For bonds that are from issuers with not so good credit quality in the event of a severe economic recession, or if there's something that affects the underlying issuers that affect their ability to pay, then that can potentially impact the performance of the underlying bonds held by the ETFs. So I guess that goes back to our earlier discussion around the average credit quality and choosing something that is ideal for our individual risk appetite. Okay, this question that's come in around T-bill. So the comparison once again, I think going back to the discussion around bond ETFs versus T-bills, I think one observation that this participant has is that the demand for the T-bills has actually stayed relatively high, even though the bond yields have come down. So why is that the case, and how should we then think about bond ETFs being a complement to T-bills generally?
So yeah, the demand for T-bills remain because of all the ongoing uncertainties. So people need safe haven assets. So in this environment, sometimes T-bills are almost close to cash. So you are de-risking your portfolio. So the flight to safety with a lot of the U.S. Tariffs driving global uncertainties, and there's even some expectations of rate cuts. So people are investing in T-bills to remain in safer asset classes. At the same time, I think the complement for bonds is the potential for capital appreciation because of interest rates going down. We've seen some of that play out in the last few months because interest rates has been going down, and that contributed to the performance of bond ETF. So I think that complements the ongoing flight to safety given all the underlying uncertainties.
Okay, so I guess in a nutshell, even though the yields of the T-bills have come down because we are generally in an environment where investors prefer more safety, so that's actually still kept the T-bills relatively attractive, and also likewise highlighting how some of these bond ETFs can come in for investors who are looking to build their income portfolios.
Yeah.
Okay, the next question relates to, uh, I would say maybe the cost of the ETF and also the hedging that is involved. I think for one of the participants who has previously joined your webinar or physical event, he noted that the hedging cost for some of these products can be zero or close to zero. Is that possible for there to be limited currency hedging costs when it comes to managing a bond ETF?
So for this bond ETF, there's no currency exposure per se because for Singapore dollar investors, the underlying investments in the bond ETFs are in Singapore dollars as well. So essentially, we don't have hedging costs. The only time where hedging cost is involved is if the underlying bonds are in another currency. let's say US dollar, and then we have to hedge it back to Singapore dollars, and that can entail some hedging costs because of interest rate differentials. A very high US dollar interest rate currently versus a lower Sing dollar would entail some hedging cost if you hedge that US dollar bonds to Sing dollar. So currently for bond ETFs that only hold Singapore dollars, there will be no hedging cost because of our base exposure, which is also Sing dollar.
So would you say that is also one of the advantages of the bond ETFs, particularly the ABF, Singapore Bond
Mhm.
Index Fund, and the investment grade corp bond ETF, in that the currency risk would be relatively limited, given that
Yeah.
most of the holdings are in Singapore dollar denominated bonds?
Correct. So essentially, we can even absolutely say that there's no currency risk from a Singapore dollar investor perspective, because really all the underlying holdings that we have are all in Singapore dollars. Whereas if you see a lot of other currency denominated bonds, like let's say in US, they probably give you a high yield. Let's say 5 or 4.5. But the thing is, you are exposed to currency risk. There's a movement of the US dollar versus Sing dollar. But for this fund, you will not be exposed to volatility and currency risk. And if you do want to remove that currency risk by hedging, there is a cost involved, which is the hedging cost, which is primarily a good measure is the interest rate differential or interest rate difference between the US and Singapore. So it has to pay back that interest rate to remove the currency risk.
Right. Okay. So thanks for clarifying the point about currency risk. The next question relates to this investor who is looking at bond ETFs, but probably from a portfolio perspective. So given the recent equity sell-off and bonds maybe holding up relatively better, I guess this is prior to the announcement that some of the trade tariffs between US China would be paused. The question is, how should we think about the relatively attractiveness of bonds versus equities generally as an asset class?
I would look at it as it's always been. Bonds is it has a the safer asset class. It behaves better in times of global uncertainty or market uncertainty. Interest rates go down when there's a lot of concerns about the growth outlook. So, for example, when markets are expecting interest rates to be cut, then interest rates will be going down, and that will be supportive of bond performance. So, and in that scenario, that will be positive for bond ETFs. And on the other hand, during a flight to safety, there is that low correlation between equity ETFs and bond ETFs. So that can smoothen out a balanced portfolio in terms of performance because of the low correlation between bond ETF and stock ETFs. So yeah, I hope that answers the question in terms of, yeah, it is a safer asset class. It has lower volatility, and it's a defensive asset class because it plays and performs well during risk off periods.
Okay, so I think that is good to know given the macro environment that we are in. While for now there seems to be some pause in terms of the trade tariffs by the US as well as by China, I think there's still a lot of uncertainty in the macro environment. So for participants who have joined us tonight and just wanting to think about the different instruments that are available and how they have a different risk profile, I think the sharing earlier around how we should think about the relative risk profile of bonds versus equities is something that is helpful for us to understand. Okay, the next question that's come in is a broader question around bond ETFs versus bond mutual funds.
Mhm.
I think earlier you touched on some of the points around potentially some of these bond funds with US dollar assets. And I think those might be bond mutual funds. So for investors who are looking at bond ETFs versus bond mutual funds, how should we think about comparing these two different products?
Yeah, so most bond ETFs, especially the bond ETFs that we've discussed, these are passive or index tracker funds. So the investment goal really is to track the performance of the underlying index. So from that perspective, it makes the fund cost cheaper. So that's why usually bond ETFs are considered cheap, because the expense ratios are much smaller compared to mutual funds, which are managed actively by the investment managers. So they need to be paid higher because they are actively managing the mutual fund. Whereas for the bond ETFs that we have, the management fees and expense ratios are much smaller because we track and monitor the tracking of the underlying index. So it's a more straightforward portfolio management. And so it's a cheaper access actually compared to mutual funds. And I think I can say that in terms of trading costs in the exchange versus having to deal with mutual funds with your banks, there will be some upfront charges that may be different compared to trading a ETF in the exchange. And sometimes that can be relatively cheaper.
So, if my understanding is correct, the total expense ratio that you mentioned earlier, that is effectively all the expenses that go into managing this ETF,
Yeah,
and that would include things like your management fees,
yeah,
your legal costs, your custody fees. So
correct.
those would then come inside the total expense ratio,
Yeah,
and that would be effectively the cost in terms of holding on to this ETF.
yes.
Can you maybe share with us what is the expense ratio of the ABS Singapore Bond Index Fund as well as the Nikko AM SGD Investment Grade Corp Bond
Yeah.
ETF?
So I just round estimates be around 24 to 26 basis points, or 0.24% in the last 3 years or so. So it's really quite small. You can check the other mutual funds, but this is really a low expense ratio of around 24, 25 basis points.
Okay, so earlier you described the process around ETFs, that they are passive instruments, and hence that actually leads to the relatively low cost in terms of being able to hold on to these ETFs. Maybe you can share with us how is the ETF actually constructed? I think earlier you shared some of the holdings of the ETF. How is the process around the constituents of the ETF actually decided, and how frequently is this actually managed?
So the ETF, in terms of investment objectives, is really to track the performance of the underlying index. And the index is created to really gain exposure to a specific market. So, for example, the ABF, it's the underlying index is created to cover all the government bonds and statutory board bonds, and that is being so new bonds are being issued regularly, and some bonds also um, exit the index because they become less than 1 year. So every month there's a index rebalancing, and so new bonds come in and some bonds exit. So because of this continuous new issues in the bond market, so we do rebalance monthly, and we also sell when old bonds get out of the index. And really our role is to ensure that we match the portfolio with the underlying index in terms of characteristics, in terms of holdings. Note that the underlying bonds is traded in a secondary market where liquidity is can be difficult. Some bonds may be difficult to find because they're issued a long time ago. But yeah, so we try to match the portfolio with the index as much as possible so that we are able to deliver the returns of the index.
Okay, so thanks for breaking down for us how we should think about the ETF, how it is benchmarked against an index, and what actually is in the work of a fund manager of a
Mhm.
ETF. Maybe if you can maybe go a bit deeper into that, because we often get the question around what actually goes into the management fees of the ETF. What would you actually be doing in terms of then managing this ETF? you mentioned earlier that there is a need to actually balance it on a monthly basis. What are some of the other things that are involved in terms of managing this ETF?
So yeah, so we manage all the rebalancing, monitor the index, monitor new issuance if there are new issues coming up. So we assess whether this will be included in the index, and so we do buy ahead when a new issue comes up. Let's say a new corporate bond is announced, and so we checked, and also at the same time we look for liquidity when we try to manage the portfolio. As I mentioned earlier, unlike the stocks wherein you can fully replicate the underlying stocks, because most of the stocks you can buy, for bond ETFs, a lot of some of the bonds, as I've said, you have to manage liquidity, and there's also flows, subscription and redemption, that we also have to manage. So really it's the rebalancing and sort of the monitoring of the market, and also ensuring that we're able to find liquidity both from a selling and a buying perspective. And there is when you trade bonds, there is transaction costs called bid offer, and so we manage to make sure that our objective of tightly tracking the index, we have to make sure our transaction costs are very minimal. So sometimes bond ETFs like ourselves are measured about how tight our tracking error is. So we have to manage as close to the index and minimize transaction costs as much as possible.
So just to be clear, effectively what you're doing is
Mm,
to be able to follow the benchmark index as much as possible,
mm.
rather than being an active fund manager and trying to do better in terms of performance relative to
Correct.
the index. Is that correct?
Correct. Yes.
Okay, so I think that is something that we also often get questions on, because for many investors who might be familiar with investing in mutual funds and thinking about the fund manager being able to outperform the benchmark, I think that is one aspect around passive ETFs that some investors may not be aware about.
Yeah, I think the reason for the lower fees is because the of the passive nature of the funds.
Okay, I'm just picking up more of the live
Mm,
questions.
mm,
This question from a participant was really going back to the investment grade corp bond.
mm.
I think she noticed the underlying bonds that are held by the investment grade corp bond ETF. I think you mentioned earlier that some of these issuers are actually having bonds that are considered investment grade credit quality,
Yeah.
but I think what this participant has noted is that for some of these bonds, they do not seem to be rated. So then how do we deem them to be investment grade?
Okay, so when we created the fund, we do find that there's a significant part of the Singapore dollar bond market of issuers that are of high quality, but they don't have global credit ratings. And so what was set up is that we have to have an implied credit rating quality. So currently, the implied credit rating quality that we use is a model being built and designed by the index provider to measure the implied credit rating quality of these unrated bonds. It's really based on the pricing of rated bonds versus the pricing of the non-rated bonds. So, as you mentioned, issuers like Keppel, Singapore Airlines, or even LTA. These are non-rated bonds, but they are included in the investment grade bond ETF because of the iBox implied credit rating. So it's a quantitative model that they built in to identify whether this bond is investment grade or not. So I think it's around 20 to 30% of our bond ETF that is allocated to this non-rated bonds. Having said that, most of these bonds are actually Singapore corporates that have very high quality in terms of reputation, and that they don't get credit rating because a lot of the borrowers or even bond in a lot of their creditors or bond investors don't require credit rating for these issuers.
So just to be clear, in this case, you're not the one who determines the credit quality of the
Yes.
issuer.
Mm,
Effectively, this is an approach and framework that is issued by the index, in this case, which is iBox, in which you use the approach to determine whether or not they fall within the investment grade corp bond kind of category.
correct. Yes. So
Okay,
it's really
so
based on historical market pricing and to determine whether the market considers this bond as investment grade or not.
okay, so I guess that goes back to the earlier point around that this is a passive approach in terms of the decision making around determining whether these bonds are investment grade or non-investment grade. That is not something that is determined by the fund manager.
Correct. So it's be determined by the index provider.
Okay, thank you. Um, the next question relates to the rebalancing that you noted earlier. How often is the rebalancing actually done? And how should we think about whether there's then a lot of cost that is involved in terms of buying and selling these underlying bonds?
So the index is being rebalanced every month. So as you well know, every month some new bond issues are being issued. So for example, the government, Singapore government, does a monthly auction, and that new issue will be coming into the index by month end. And so every month end there is a new bond that can come in, and so we rebalance monthly. And also, when you have significant inflows or significant redemptions, you also need to rebalance to make sure that while selling or buying new bonds, you are able to match that with the index.
Okay, so hopefully that provides more clarity in terms of the approach being taken to be able to ensure the ETF actually follows the benchmark index as closely as possible.
Correct.
Okay, so I think we have gone through quite a bit in terms of understanding bond ETFs. We have gone through two of the bond ETFs as well, understand what is the underlying, how do they compare against treasury bills, look at the advantages as well as the risk. Um, do you have any words to be able to share with our participants tonight as a summary on how we should think about this bond ETFs?
So, for me, bond ETF, or it's a really an asset class that you can consider and look at as part of your portfolio. It has a role. T-bills is for short-term, short duration, 6 month, 1 year duration exposure, while the two ETFs that we've shown, these are of higher duration kind of exposures. So the ABF Singapore Bond Index Fund is, if you can consider it, if you're looking for a Singapore government kind of exposure. It performs well during risk off environment. It performs well and have potential capital appreciation when interest rates are falling. It performs well when monetary policy or governments are cutting interest rates. So if you are able to invest in bonds directly, then that's good. But the bond ETF is a cheaper way of going into the ABF, of going into the bond asset class. Um, Similarly, if you want potentially higher yield than government bonds, then you would consider the investment grade corporate bond ETF. You can buy your own bonds directly, like a corporate bond. But having said that, note that a single investment in one corporate bond can be quite high. For example, a corporate bond minimum size is 250,000. So for most investors, you can only buy one bond. And well, as for the Singapore investment grade corporate bond ETF, just maybe for $1,000 or $10,000, you can have a portfolio diversified already, exposed to investment grade corporate bonds. So I think that's where the advantages is of this bond ETFs is that you get instant exposure with just one trade in a portfolio of bonds. So if you want to learn more about this bond ETFs, this is our website, and it's a simple way of investing in bonds, and it's really that asset class, and if you know that this is how this asset class performs, and then these are the allocation tools that you can use in terms of gaining exposure to Singapore bonds, the government bonds, and the investment grade corporate bonds.
Okay, thanks so much, Bertram, for all your sharing tonight about the
Yeah.
bond ETFs. I think you rightly mentioned that for investors who are looking at potentially a safer asset class compared to equities, especially in a continually volatile economic environment, then bond ETFs would be something that can be considered, given that historically there have been lower volatility compared to equities as an asset class. So thanks so much for joining us tonight. You have actually shared the Nikko AM website here. And for participants who have follow-up questions about bond ETFs, you can go to the Beansprout website as well to be able to pose your question. And we hope to be able to answer your question around the bond ETFs. So once again, thanks so much for joining us tonight. We hope that you found the session helpful and that we have been able to share more about bond ETFs with you tonight. So thank you so much for joining us and have a very good evening. Thank you.
Thank you, everyone. Thanks, Gerald.
Thank you.